Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, June 6th at 11 a.m. in New York, so let's get after it. Over the past several months, we've been highlighting the declining trend in earnings revision breadth. However, it's been a slow-moving train, and we're barely below zero at this point. This is why forward 12-month earnings estimates are still grinding higher for the S&P 500, and one reason why stocks have rallied over the past few weeks. But now valuations have risen back to 17.5 times earnings, despite a rising 10-year Treasury yield. In order for this to make sense, however, one must take the view that earnings growth will reaccelerate later this year. Time will tell, but we think S&P 500 earnings growth will slow further rather than reaccelerate. Some have argued these revisions were fully priced, with the major averages down more than 20% year to date. In short, the earnings risk is now understood, and the market is looking forward to better growth next year. In the absence of further revisions in the near term, that view can hold up for now. However, if earnings revisions don't reaccelerate, we think the price is too high. This is why we think it could be difficult for the equity market to make much upward progress this summer or fall from current levels. Either the price needs to come down to reflect the further earnings risk we foresee, or the earnings need to fall. We think both will happen over the course of the second and third quarter earnings season as companies come to the confessional one by one. In the absence of a recession or a shock like the COVID lockdowns, negative earnings revisions typically take longer than they should, and this time is likely to be no different. Therefore, we remain open-minded to the idea of stocks hanging around current levels and even rallying further in the near term, especially if there's some kind of pause or ceasefire in the Russia-Ukraine war. However, even if that were to happen, we don't think this reverses the fire and ice that is now well established but incomplete. Bottom line, the bear market rally that began a few weeks ago can continue for a few more weeks until the Fed makes it crystal clear they remain hawkish and earnings revisions fall well into negative territory. That combination should ultimately take the S&P 500 down towards our 3,400 target by mid to late August. As we've been highlighting all year, equity investors should be more focused on single stocks and relative opportunities across sectors. In that regard, real estate has seen the strongest earnings revisions over the past 4 weeks. Food, beverage, and tobacco, commercial and professional services, and materials have also seen a positive change in revisions. Finally, capital goods and the overall industrial sector have fared relatively well over the past 4 weeks as their absolute revisions have remained flat. The weakest revisions have come from consumer and tech industry groups, two areas we remain underweight. Food and staples retailing revisions have collapsed over the past 4 weeks as concerns over cost pressures on top of already thin margins hit the space. Consumer discretionaries also continue to see weakness in revisions over the past 4 weeks, despite some modest relief more recently over the past 2 weeks. Bottom line, U.S. stocks appear in the midst of a bear market rally that could run a few weeks longer. The NASDAQ and small cap indices will outperform under that view in the short term. However, we remain defensively positioned into the fall, when a more durable low in equity markets is likely to coincide with a bottom in earnings growth. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.